Hi, welcome to Solution in YouTube channel. In today's video, we will learn about weighted average cost of capital. The weighted average cost of capital represents a firm's average cost of capital from all sources, including common stock, preferred stock, bonds, and other forms of debt. The weighted average cost of capital is a common way to determine required rate of return because it expresses, in a single number, the return that both bondholders and shareholders demand in order to provide the company with capital. A firm's weighted average cost of capital is likely to be higher if its stock is relatively volatile or if its debt is seen as risky because investors will demand greater returns. In corporate finance, determining a company's cost of capital is vital for a couple of important reasons. For instance, weighted average cost of capital is the discount rate that a company uses to estimate its net present value. Weighted average cost of capital is also important when analyzing the potential benefits of taking on projects or acquiring another business. If the company believes that a merger, for instance, will generate a return higher than its cost of capital, it's likely a good choice for the company. If its management anticipates a return lower than what their own investors are expecting, they'll want to put their capital to better use. In most cases, a lower weighted average cost of capital indicates a healthy business that's able to attract investors at a lower cost. By contrast, a higher weighted average cost of capital usually coincides with businesses that are seen as riskier and need to compensate investors with higher returns. If a company only obtains financing through one source, say, common stock, calculating its cost of capital would be relatively simple. If investors expected a rate of return of 13% in order to purchase shares, the firm's cost of capital would be the same as its cost of equity, 13%. The same would be true if the company only used debt financing. For example, if the company paid an average yield of 7% on its outstanding bonds, its cost of debt would be 7%. This is also its cost of capital. However, many companies generate capital from a combination of debt and equity financing. In order to express the cost of capital in a single figure, one has to weigh its cost of debt and cost of equity proportionally based on how much financing is acquired through each source. Let's say the weight of debt and equity is 50-50. Then, ignoring taxes, the weighted average cost of capital will be 10%. Using this idea, the formula will like this. Let us break down the formula. E represents the market value of equity. D represents the market value of debt. The V represents the total market value of the firm, means collective total market value of equity and total market value of debt owed from a firm. KE represents the cost of equity. It is the rate of return that investors demand based on the expected volatility of the stock. To see how to calculate cost of equity, you can see the detailed video about cost of equity. The link to this video is given in the description. KD represents the cost of debt. Determining the cost of debt is a more straightforward process. This is often done by averaging the yield to maturity for a company's outstanding debt. Businesses are able to deduct interest expenses from their taxes. Because of this, the net cost of a company's debt is the amount of interest it is paying minus the amount it has saved in taxes. This is why after tax, KD is taken for the purpose of calculating weighted average cost of capital. Now let's take an example and solve it for weighted average cost of capital. Assume a company has total number of shares outstanding equaling 5 million with current market value of $50 per share. The market value of equity will be $250 million calculated by multiplying per share market value with total number of outstanding shares. The company's equity beta is 1.6, with the risk-free rate of 3.5% and expected market return is 11%. The market value of debt for this company is $350 million, with average yield till maturity of 9%. The average corporate tax rate at this time is 35%. By adding the market value and equity, the total value of firm will be $600 million. The cost of equity will be calculated as per capital asset pricing model equaling 15.5%. The after-tax cost of debt will be 5.85%. Based on this information and using the formula, the weighted average cost of capital will be 9.87%. Note that the individual costs of equity and debt are different from the weighted average. This difference is due to the weights assigned to the capital structure of the company. Now you have a basic understanding about weighted average cost of capital and how it is calculated. If this video was helpful, please hit the like button and don't forget to subscribe. See you in our next video. Take care.